Taxes in retirement is a lot like swimming with weights in your hands. Many people are just unaware about how much tax liability they're actually carrying around. So in this video, we're going to show you how you can drop the weight and be more efficient with your retirement planning in 2025 and beyond. Let's start with what you need to address before year end. This will also help you with tax planning throughout the year. Many people know about tax loss harvesting, which is selling an investment in a taxable account at a loss to offset any gain they've already taken or realized gain. But did you know there are ways you could pay zero capital gains taxes? Many retirees miss this one. Had a client of mine. He had a low-cost basis stock that he's owned for 20 years or more. And he really didn't have a lot of other income. And I asked him all these other questions. The only other income he had was a little bit of dividend income off that stock. And he needed some money. He was married, filing jointly. And so because I knew about this situation, I said, hey, you don't have any other income? No. Married, filing jointly? Yeah. So I got on the phone with his CPA and I said, hey, this is a scenario here. It seems to me that he can sell over $100,000 worth of this stock and pay no capital gains tax. Is that true? CPA said, gave me the thumbs up. Yes, that's true. Many people miss this. So let me share with you how capital gains are calculated. If you only had capital gains tax of $123,000 and no other income, you pay no tax in 2024. You can have $223,250 worth of capital gains tax and pay zero capital gains. Why? Well, if you're married filing jointly and over to age 65, that is the amount of money you can have and get a standard deduction and be below the $94,050 tax rate for capital gains. That is, if you're single, the amount is $47,250. So you could have a capital gains tax of $61,625 and pay zero capital gains. And you can see that in the graph here. Now, let's suppose, for instance, that you had an IRA withdrawal of $32,300 and you still had $100,000 worth of capital gains tax. What that does is it pushes up your capital gains tax from non-taxable to taxable. So can you see how other income can push up capital gains tax that was previously not taxable? So you need to keep this in mind, that all forms of income that you have throughout a year can affect how much taxes you pay. And it can push up capital gains from being tax-free to taxable. What we do is pull in info from the accounts they have with us, and we really try to get an idea of what the income is that they have with accounts outside of us, like bank accounts, money market accounts, and the like. When you have all this income coming together, then you can get a clearer idea on how much you need to do for Roth conversions, tax gain harvesting, or pull income into this year or punt that to next year, or take deductions this year or push them into next year. The point is IRA withdrawals and other forms of income can create tax not only in the amount of the IRA withdrawal itself, but it could also create capital gains tax. Let me show you what I'm talking about. I have an example. We uploaded the client's tax return here, and we're able to model in certain scenarios. In this example here, zero capital gains tax. We've got all of his other forms of income here on the right, and we modeled in total income, deductions, and we go over to range calc and let the magic happen. Okay. So what you see here is how much capital gains he could take You see this red here? The red here is capital gains. This is how much more he could take $45,000 more of capital gains tax and pay no capital gains tax. Or he could make Roth conversions here up into the 10% level, or up to here to be at the 15% level. So when we're able to see all the other forms of income, we can kind of fine tooth comb it and dial in exactly how much she needs to take in capital gains, or or do for Roth conversions. It's way better to pay 0% tax on something than it is to them paying no tax at all. One kicks the can down the road and you have to pay the tax later. The other one actually puts that can into the garbage and avoids taxes altogether. Many people give away money at the end of the year. They give it to their kids, grandkids, and whatever, or to charity. If you're over 70 and a half, you can do that as a qualified charitable distribution. Many people think that if they give money to charity and they get a tax deduction, but it really doesn't have a lot of impact on them tax-wise unless they give enough to be able to itemize deductions. If you give it as a QCD, qualified charitable distribution, you need to be over 70 and a half years old. The limit is $100,000 per IRA owner, and it counts towards your required minimum distribution. It's generally way more efficient to do it that way. But if you give money to the kids and grandkids, the annual amount you can give in 2024 is $18,000 without a gift tax, or unless you use your estate tax exemption. One thing to keep in mind though, if you're giving money to the kids, they need to cash the check before year end for it to count in that year. Another important thing to keep in mind is educational accounts or 529 plan accounts. You can give that $18,000 in a 529 plan account for your grandchildren, and in some states it allows you to have a state tax deduction. A lot of times people think that these 529 plans accounts are only for college. Not now. You can use that from K through 12 for private school. You can use that for other types of trade schools later in life. A lot of times you can create an educational legacy. Let's say that your child or grandchild doesn't go to college and doesn't use it. They can take out $7,000 per year for their Roth IRA contribution for 5 years for a total of $35,000. Or guess what they can do? They can sit back, use that, let that money grow, and use it for their future children or grandchildren, creating an educational legacy. Another thing you want to check throughout the year is making sure that you're deferring enough money into your retirement plan accounts. A lot of times people aren't saving enough in their 401ks, and they're not getting, number one, they're not getting their match, which is you're throwing money away, free money, if you're not getting the full match. The second thing is you want to try to save as much as you can up to the maximum amount. Would you like to know a mistake your friends and neighbors likely make? Your IRAs, annuities, and your life insurance policies have named beneficiaries. You probably remember writing those things down, right? Well, there are two ways you can think about beneficiaries. One is per capita and one is per stirpes. Per capita is usually the standard, meaning that if you've got 3 kids, in this particular example, Alice, Bart, and Charles, and Alice dies, and if it's per capita, the money goes to the other 2 siblings. But if it is per stirpes, or called by roots, if you know your Latin, which I do not, it goes to Alice's children. If Alice predeceased Bob, the parent, her share would go to their children. That's called per stirpes. So if you want it to go to the heirs of the deceased, you need to check off the per stirpes on the beneficiary information. Now let's talk a little bit about 2025. Medicare drug costs are expected to be capped at $2,500 in 2025. So insurance companies may be looking at ways to offset that cost. And how do you think they might offset that cost? By charging you more money. So you may want to balance or take a look at Medicare Advantage plan or traditional Medicare, or vice versa, for your type to cover your type of coverage. Another change that's going to be happening in 2025 is there's going to be a 401k turbo savings. I made up that word. But pretty much if you're aged between 60 and 63, you have the ability to get 150% more of your catch-up contribution in your retirement plan. So for 2024 is $7,500. That means you can put in $11,250 of your catch-up contribution. That's over and above the standard amount. You've made it this far. Now put the weight down. Congratulations. Give yourself a pat on the back. Now, how do you apply these to your particular situation? Check out our other video on Social Security and how to coordinate that with your other retirement income. And like and subscribe.